Welcome to Talk Tickers, your essential shortcut to understanding the complex world of earnings calls. We don't just read the slides, we really try to distill the strategic pivots, the surprising facts, and the core insights you need.
And today, we're doing a deep dive into Sony Group Corporation's Q2 results for their fiscal 25. That's the period ending September 30th, 2025. In this call, it was pretty dynamic. You had record numbers, but also a big kind of painful cleanup in gaming.
Right, and the market reaction was, well, decisive, wasn't it? That stock jump.
Yeah, a big 4.25% gap up right after the news. Investors were clearly looking past some of the noise.
So our mission today is to unpack why. Why did the market like this report so much, even with that, headwind in gaming?
Let's start with the headline numbers, the beat. That really sets the stage. So revenue from continuing ops, $3,107.9 billion. That's about $20.8 billion US.
Okay, and that was up year over year.
Up 5% year over year. And not just up, it was a record Q2 for revenue. Beat consensus too, modestly.
But the real story, I think, and what drove the stock was probably the profitability, the margin.
Exactly. Operating income, $429.0 billion. That's up 10% year over year, also a record Q2. And that pushed the overall operating margin up to 13.8%. Pretty strong.
Very healthy. And the EPS beat expectations too, right? IFRS diluted EPS was 51.71, about 35 cents US.
Yeah, comfortably beat the street, which was looking for around 34 cents. So up 7% year over year there too.
So the overall picture is operationally, things are accelerating.
Right. And what's really interesting is that this happened even with the big issue in the gaming segment we need to talk about. It tells you that the other parts of the business, those growth engines, are running really hot, hotter than expected.
Okay, let's get into those engines then.
Yeah.
Because this quarter really seemed to highlight Sony's focus on IP and technology, right? Two segments really stood out. Music first.
Yeah, let's start with music. Phenomenal results there. Sales jumped 21%.
21%.
And operating income up 28%, both new records for a Q2.
Wow. What's driving that kind of growth in music? Is it still mostly streaming?
It's largely streaming, yeah. Double-digit growth there. Recorded music streaming revenue was up 12%, and publishing was up a huge 25%. That's on a US dollar basis.
Okay, but there was more to it than just streaming, wasn't there? Something about IP.
Oh, absolutely. This is where the IP strategy really shows its power. Visual media and platform revenue was massive. They specifically called out the anime IP Demon Slayer. Kimetsu no Yaiba Infinity Castle. The global theatrical release was a huge success.
Right, I remember hearing about that one.
That and another film called Kokuho. Management actually said those two hits alone drove about 50% of the music segment's operating income upside for the quarter.
50% from just two properties. That's incredible concentration.
It really is. And it proves their point, right?
Sure.
Own valuable IP that works across platforms, and you get these high-margin, kind of predictable revenue streams. It smooths out the cycles elsewhere.
Okay, so that's the IP engine. What about the technology side? The other big performer was Imaging and Sensing Solutions, I&SS.
Yeah, their semiconductor and sensor unit, I&SS, was, an absolute powerhouse this quarter.
Right.
Sales were up 15%, which is solid, but the really critical number was operating income. It just soared, up 50%.
50%. Okay, that's the kind of number investors notice. How do you get that kind of profit jump? Can't just be selling more sensors.
No, you're exactly right. It's all about the product mix and, frankly, their technology lead. The growth came from higher prices, specifically for those large-size sensors that go into premium smartphones.
The high-end phone cameras.
Exactly. These aren't just basic chips. They're specialized large-format sensors that enable, the really advanced photography, the computational stuff, even some AI features now. And because Sony leads in this high-spec area, they have real pricing power, better margins. It's structural demand, not just cyclical.
Got it. So music and I&SS are firing on all cylinders, driving revenue and margins. But we have to talk about the elephant in the room.
Yeah.
Gaming and network services, G&NS.
Right. G&NS sales there were up, but only modestly, about 4%. The issue was operating income, which actually decreased 13% year over year.
Okay, why does it drop?
It came down to one big thing. A non-recurring loss of almost $50 billion. 49.8 billion to be exact.
Whoa, 50 billion yen. That's a huge hit. What was that charge? Was it just like the division losing money?
Not exactly operating losses in the usual way. Management called it an impairment of intangible assets and also a correction of some development costs they'd previously capitalized.
Okay, in simple terms.
It was basically a write-down related to Bungie. specifically tied to the long-term outlook and the development costs for Destiny 2.
Ah, Bungie. So the acquisition isn't quite panning out as expected.
Essentially, yeah. When the projected future revenue from an acquired asset like Bungie's IP or ongoing development looks lower than originally planned, accounting rules say you have to reduce its value on the books. That's the impairment charge.
Management really tried to frame this as a one-off cleanup, though.
Yeah.
They said if you ignore this charge, G&NS operating income would have actually been up 23%.
They did. And that's the core tension here, right? Is it just a necessary financial adjustment to clear the decks? Or does it signal deeper problems with the Bungie integration or their live service strategy?
It's a fair question. But looking at the platform itself, the underlying health seems okay. Didn't they mention user numbers?
Yeah, that's the counter-argument. Monthly active users are still very high, 119 million. Playtime actually ticked up slightly, 1% year over year. And importantly, live service games are now generating over 40% of their first-party software revenue. So the model is working in places.
And specific games are doing well too, right? Helldivers 2.
Helldivers 2 is still doing great, yeah.
Okay.
And it even launched on Xbox recently, expanding its audience. And Ghost of You sold over 3.3 million units pretty quickly. So there are definite bright spots. They're also sticking to the plan for Marathon, their big new live service title, still expected to launch within this fiscal year.
Okay, so maybe investors bought the cleanup story. They see the platform health, see management taking the hit now, and figure it clears the way for future growth.
That seems to be the read, yeah. Because that confidence allowed everyone to focus on the forward guidance.
Which was good.
Which is very good. That's what really lit a fire under the stock. They lifted the full year FY2025 operating profit forecast by 8%.
8% hike mid-year is significant.
It is. They raised it from 1.33 trillion up to 1.43 trillion. That's a 100 billion increase.
Okay, what drove that 100 billion hike? Was it just music and I&SS continuing to outperform?
That's part of it, but a big chunk actually came from external factors, specifically U.S. tariffs.
Tariffs? How so?
They lowered their estimate for the full year tariff impact, dropped it from 70 billion down to hefty billion.
So that's 20 billion in unexpected relief right there. That's huge. How'd they manage that?
They mentioned mitigation actions and, importantly, removing tariff assumptions from the I&SS segment forecast.
Ah, so maybe shifting production or maybe just realizing those high-end sensors aren't as impacted or they can pass costs on.
Probably a bit of both. Diversifying manufacturing certainly helps, and the pricing power in I&SS gives them flexibility. It softens the blow significantly.
Okay, so strong results, raised guidance. What else? There were some strategic moves too, weren't there? The financial services spinoff.
Yes, exactly. Sony Financial Group, SFGI. That spinoff and listing became effective October 1st, right after this quarter ended.
And why does that matter to the market?
It simplifies the whole Sony story. It gets rid of a division that didn't really fit the core narrative anymore. It lets Sony and investors focus squarely on the main engines, that IP-driven entertainment side and the high-tech semiconductor side.
A cleaner story.
A much cleaner story. And they immediately underlined that focus by announcing a new share buyback program, up to 100 billion by May 2026.
Returning cash, boosting efficiency, makes sense.
Yeah. Signals confidence and a focus on shareholder value post-simplification.
So stepping back, the big picture narrative seems clear. Sony is increasingly becoming this IP and semiconductor powerhouse.
That's exactly how the market is seeing it. And rewarding it. You look at the Sony ADR stock performance over the last year. It's crushed the Nikkei 225 benchmark.
Significantly outperformed, yeah.
Yeah.
Something like 60+% versus maybe 30% for the index.
Right. So the market's reaction to this report, focusing on the guidance and the SFGI spinoff, suggests they believe this isn't just a good quarter, it's a sign of a structurally higher earnings potential going forward.
Betting that music and I&SS can consistently deliver those high returns.
Pretty much, yeah. Offsetting the ups and downs of the console business.
But management did sound some cautious notes, right? We should probably cover the risks they highlighted. Beyond Bungie, I mean.
Oh, definitely. They were careful not to sound too optimistic. While they're cleaning up G&NS, they still flagged pressure from high development costs across gaming.
Okay.
And maybe more concretely, they warned about component price volatility, specifically NAND flash memory.
Memory prices going up.
Yeah.
That could hurt PS5 hardware margins next year.
Exactly. That's a direct risk to hardware profitability, which is always pretty tight anyway.
And they mentioned the broader economy, too.
Yeah, just general caution about the global business environment. They specifically cited seeing some signs of a slowdown in the U.S., so, managing expectations.
Right. Okay, let's shift gears then. It's time for our final segment. This is emphatically not financial advice.
Definitely not financial advice.
But we like to look at the data from the call and pitch a, let's say, high conviction, maybe slightly outrageous trade idea based on what we heard.
Okay, I like this one. The setup, I think, is that the market still might be underestimating just how structural that margin growth in I&SS is.
You mean the 50% profit jump isn't just a one-off?
Exactly. That demand for premium large sensors, especially with AI features needing better imaging, that feels like a multi-year trend, maybe even accelerating. It's not just cyclical.
Okay, so strength in I&SS is maybe underestimated. What else?
And the Bungie charge. That $49.8 billion hit, it's painful. But it does clean the slate for G&NS. It potentially sets them up for a much stronger rebound comparison-wise once that charge is in the rearview mirror and hopefully some of those new live service games like Marathon start hitting.
So the pain's taken, guidance is up, company's simpler.
Right. So the trade pitch is consider a long position in the Sony ADR, maybe using medium-term call options.
Options, okay. What kind of time frame and target?
Thinking maybe 6 to 9 months out, targeting maybe the mid $34 range on the ADR. The idea is that this recent pop isn't the end. It could be the start of a re-rating as analysts digest the raised guidance and hopefully see success with upcoming game launches, betting on continued momentum.
So a bet that the operational cleanup and the tech dominance story has further to run. Interesting.
A bet on execution, basically.
Okay, a disciplined bet, as you said. That wraps up our deep dive into Sony's Q2 FY2025 results.
Yeah, the key takeaway really is record quarter financially, that big 8% guidance hike, and the simpler structure post-SFGI, all pointing towards those core growth areas.
All right, now for that final provocative thought for you, our listener, to chew on. Management spent time emphasizing risk management, cautioned about the economy, but the market, it seemed to just grab onto the growth story, right? So considering that huge write-down for Bungie, which was an acquisition of creative assets, has Sony really put the G&S issues behind them? Or does leaning so hard into this IP-centric vision maybe create new risks, execution risks in areas where maybe they don't have decades of internal experience like they do in hardware?
That's the question, isn't it? Is integrating and managing massive external game studios and live services harder than it looks? Something to think about. We definitely encourage you to keep digging, maybe look at how other big IP integrations have played out historically.
Absolutely. Thanks for diving deep with us on Talk Tickers. We'll catch you next time.